Hi, I'm Alex Zukernik. I'm the president and CEO of NOVR Royalty. We're listed on the TSX Venture Exchange under the ticker NOVR. We are a royalty company focused on copper and nickel, which we really see as the most fundamental commodities in the entire energy transition. And we really wanted to find a way for people to invest in really the key building blocks of the entire movement, which is really the big copper and nickel mines, through the best way possible, which is a royalty, which gives you access to the revenue line and free of cost or any other capex obligations.
And some would say almost inflation proof. Alex, good to see you again. We saw you back in October 2020, just when you kicked off, actually. You've been busy?
Yeah, you can say that.
Yeah, I know you have. I've read about it. I think given it was such a long time ago, I'm going to treat this as like a first time we've met or spoken. Okay, so royalties focused on copper and nickel, get it. But why don't you just remind us what you set out to do? What did you set out to do back in October 2020? Has that evolved or changed any since I saw you?
Well, look, we started the company in the summer of 2018, and we spent 2 years private, really making sure that by the time we went public, the company was really ready to grow. And what we saw when we began was really just a generational opportunity. I mean, the world was changing in a very fundamental way. And so if we were before in the age of oil and coal, what we saw was really the emergence of the copper age. And we wanted to start a company that would allow people to participate in that in the most advantageous way, which is a royalty. You haven't really had a copper royalty company in mining before, and because copper was never considered so strategic. And so as a first mover, what we did literally, we put together a great team really all around the world. I mean, right now, the NOVR team, when you include everyone who's involved, is over 20 people, which makes it in all the key camps. And we mapped out all the regions, every mine that was of relevance to us. And we found the royalty holders from whom we wanted to acquire these royalties. Now, if you want to buy a royalty on a top-notch copper mine like Taka Taka or Westwall or Overunion or any other things we have in the portfolio, you're not going to get them from the companies themselves, because these large companies like First Quantum or Teck or Glencore, they don't sell direct royalties on their prize deposits and their prize commodities. There's actually never been a deal like that done that I know of. The only time that the royalty will be generated is when those companies buy the deposit from the original prospector who found the mine, and the royalty is generated and given to the seller as their upside participation. Now, because it takes 30 to 40 years often for a mine to go from exploration to production, people who receive these royalties, they get tired of waiting. And where NOVR comes in is we come in usually in that final stretch before production, say the last 5-7 years or so, when there's clearly a visible resource, there's a viable production plan, there's a viable owner or a clear transition to a viable owner in the very near future. And we buy that royalty with a reasonable price between cash and shares. And we really provide a solution for them. And us being now a diversified company listed on the exchange, we provide investors something unique to invest in. And it's been
okay. Well, I think before we kind of run away and tell me the whole story, I just want to sort of dig into a few areas there that you've mentioned, right? So we understand the model, and understand what you're trying to do and the advantages. Let's go back to the team side of things. Okay, so when you kicked off, obviously I'm trying to work out, have you evolved since the early days? Have you learned a thing or two along the way? So, again, when you kicked off, what was the experience in terms of transacting on royalties? And how many royalties had the team done at that point?
Well, when we started the company, so Brett Heath, who is the chairman, myself put it together. Brett obviously did a great job putting together Metalla in the gold silver space. So I think we covered off all the key components you needed. Off the bat. So the royalty experience we have with Brett, our initial chairman was Parvi Farsangi, who was the former chief operating officer of Valley Inco. We're in the world's second largest nickel business. And if you look at the technical committee, that we have, plus these people who are not even disclosed, we probably have as good a technical team between engineers and geos around the world as any.
Well, there's two bits to that, aren't there? There's the actual, putting the royalty together or picking up the third party royalty and, analyzing it, having the technical team to experience to actually work out whether it's good or not, whether it will get into production, whether the economics do actually stack up, etc. So you talked about 20 people earlier. How many of those are internal? How many external? How many full-time? How many part-time?
It's actually interesting. So we've got right now 3 full-time employees. And then everybody else who's involved with the company is, almost everyone's been there from the very beginning. And it's usually some mix of, cash and shares, really that kind of give people an incentive, and there's a real skin in the game. And that structure has worked really well. For a while, I was the only full-time employee, but we still had a very sizable team around the world that allow us to function and get a lot of things done.
Right. So you had consultants available to you as and when you needed them. So
I think it's more than that. They're
okay.
not just consultants.
Okay.
I think the key is if you just rely on consultants, people who have 20 other things happening, I think it's really tough. We had people that work with us, kind of in a very intense way from the start. They just weren't full-time employees. And that's really what's allowed us to continue.
What's the difference? I'm struggling with the difference. What's the difference?
Well, the way I think of consultant is someone who you hire for a specific task. They do it and they kind of go away. We have people on an ongoing monthly basis, who
on a retainer.
They regularly get correct. Plus they get regular options and the like. So they've really been a part of the company from the very start.
Okay, fine. And that in terms of the track record of these people, just give me an example of what, why you would have hired them. Like what had they done in the past? You say, you know what, that's perfect. That's a perfect fit for us.
Absolutely. Yeah. So, look, it kind of part of it was obviously our initial chairman. And then Darren Wagner, who is 2-time Prospector of the Year in Canada, one of the former senior geologists at Tech and founder of West Timmins and Balmoral and Platinum Group Metals. He's in our advisory committee. Frank Hannegarn, former chief operating officer of Core Mining. He's there as well. Christian Rios, who is based in Lima, really one of the best geologists in South America. So I guess I could keep on going down the list, but it's a really strong group that we've had the privilege of from the start. Right.
So that's on the technical side. And what about in terms of the actual the royalty, the paperwork? How do you know that you're not overpaying for something? Because royalties tend to be quite competitive, although you are kind of niche. You focus on green metals like copper and nickel. Some of the PMs do have those things in their portfolios too. So you don't necessarily want to overpay. How do you make sure that is the case?
Well, I think the first thing you think about before you even get to the economics is you need to buy tier 1 assets. When you look at the royalty space, all the most successful deals have been done in tier 1 assets that keep on expanding. And so, there's no such thing as buying a really good asset really cheap today based on current projections. I've never seen that. But when you look at all the outperformance that's been generated in this space by some great companies, you buy really good assets at reasonable prices today and you let them grow. And that's what we've done. So we bought Taka, we bought Visca Cheetahs, we bought Westwall and Overunion and the like, and you buy tier 1 assets at reasonable prices. You're comfortable with your technical evaluation. You're comfortable that you've underwritten to a reasonable rate of return today. You obviously go to legal paperwork to make sure that everything is proper and registered and the like and valid. And if you have those pieces, you have a deal that makes sense. And that's what you try to do.
But it does ultimately come down to the economics, obviously. So I guess I'm sort of intrigued about how you weigh that up. But what do you think? Because you've kind of first mover advantage, there isn't a lot of competition. You're not in some sort of bidding war like the precious metal guys tend to have to take part in. The banks make them. And do you think you're picking up fair value as a result of that lack of competition at the moment?
Listen, I don't know if necessarily you would differentiate between the precious and us from that perspective. Not everyone participates in the auction.
Well, who are you pitching against then? Who do you pitch up against when you find
the reality is, it's not even, look, every royalty we've bought, we're not the first royalty company to talk to them.
Okay.
And I just don't think it's possible. The world is too small. But I think what we do is this is a space we focus on. This is all we think about, whereas other people that may have talked to do a lot of other things. And so we've done all the technical work up front. We know exactly what we want before it shows up. We don't need time to turn around and do diligence once we see something because so much has already been done. And you're able to act quickly on things that are priority for you. I think that's the differentiator. If you find yourself in a situation where it's an auction and it's coming out sort of clean corporate office and the like, I think you could potentially create value for yourself there. But it really, I think, is maybe like a one-off type transaction. It's very difficult to do that consistently and actually generate value for your investors because obviously these things get bid up pretty aggressively.
I guess the other, I was just also thinking that there are very few tier 1 copper, nickel projects in the world. tier one. But well, actually, what do you mean by tier one? Let's define that first.
Tier one, I mean something that a major company is either developing or will want to develop in the next 5 years.
How many of those are there?
Right now, there's not a lot. I mean, we from what we own and what we're trying to buy, hopefully we'll get to critical mass of those. And I think that's a super attractive thing for investors to own, because then it's something that can be that will be an asset that evolves for generations. And I think that's a super unique kind of a level of exposure. When you look at the copper space, you'll be lucky to see one major copper mine come into production a year in the world. There's just not a lot, because the level of capex you need, you're talking every major copper mine, no matter what capex they put out, you're probably going to be close to 5 billion by the time you're done. It's just the nature of the business. So even for the really big, serious companies, tech, First Quantum, these are company making investments. I mean, so I was following First Quantum's up there in Taka, so it looks like they're moving full speed ahead. Detailed engineering is being done. Permitting is very well advanced. They're highlighting production decision 2023-24. But it's like constructing a new civilization over there. It's just a massive investment.
It is, and I agree with you. Like copper typically, well, not always, but typically it requires a huge capex. Okay, but this is, and I want to move on to the portfolio now, because this is a bit interesting. Because I think when we spoke, you were proudly announcing to me the Janus Lake deal with which Rio Tinto were investing a little bit of money into trying to explore and work out. And I'm not sure that's going ahead now or not. But your deal size then that you're happy to do versus your deal size now that you're indicating we need tier one only, has that evolved in the last 2 years?
I mean, it's evolved, I think, in terms of what we can comfortably do. So when we went public, we were 20 million market cap. And so I think, obviously we knew what we wanted to buy over time, but there's only so much that you can digest at any given point. As the company has grown, we've added to the portfolio. I think the assets have advanced, which is the most important thing. When you buy something, you're judged on whether the assets are actually advancing toward viability, rather than just sitting there as potential hypotheticals. Investors have supported the company, and it's easier for us to go and do, larger deals. So for us to do a 20, 30 million transaction today is a very viable situation. We don't have to think about too much.
Okay. So maybe before we get into the portfolio, then maybe let's talk about the money, right? So is there any revenue today?
Yeah. So we picked up our first cash flowing mine in Mexico, in August of last year. Yeah. Called Aranzazu. And we watched that for about 18 months, and it's really one of the best mid-sized copper mines out there.
So how much?
We paid $9 million.
Yeah.
And so the revenue, we estimated the revenue about $1.5 to $2 million a year on that mine. Okay. And it looks like it's got a good amount of runway, kind of ahead of it. So it's very encouraging.
So 1.5, you haven't had a full year yet. So will your that 1.5 million to 2 million would be this year, 2022, you suspect, or would that be a ramp up?
No, I think for 22, that's a reasonable number for sure.
Okay. And what would that? How long would that last? What's the life of that?
I think the official sort of resource reserve right now is about of P&P and M&I is about 10 years.
Okay.
Plus you got another 3 years of inferred, which we wouldn't even count in our initial calculation. And they've been converting the inferred pretty aggressively. So if you look at Aranzazu from the time that they opened the mine, the reserves and resources are higher than they were in 2018 when the mine was reopened. Production is up, I think, double at this point, and costs are down every quarter. So what we saw when we bought it was something that can definitely go on for decades, just given kind of what you've seen in terms of resources over replacement and the performance of the management team in really just working the ore body.
Okay, so just sticking on the money side of things, so you raised whatever it was, 13.6, nearly 14 million bucks back in August. And how much have you raised to date?
We have done, in terms of cash, I'll tell you. So we've done 2 public financings. I think total about 28 or so.
Right.
And then BD Capital has put in another. So in cash, and I'd say 2.8, I think it'd be about 45 million or so.
Okay,
something like that.
Fine. And have you got any facilities in place, or what do they look like? What are the terms?
Yeah, BD Capital has given us a convertible note facility.
Okay.
And they're a major shareholder of the company, so it's great to have that support. So it's not your typical convertible note facility where you have a creditor first. So they own about 10% of the company, and we have about 18.5 million available. on a convertible note facility as well.
Okay, fine. So so let's sort of move, I guess, to the portfolio. Well, it's a mixture of the portfolio and revenue flow. So if I look at your revenue profile, have you kind of given guidance to the market as what you think that could look like? You've talked about one so far, 1.5 to 2 million, potentially 10-year and maybe extended. But what are the other near-term revenues that you're expecting, say within the next couple of years?
Look, I mean, the way we saw it was, if you want a near-term producing copper mine means if it's starting to get built today, it'll be producing by the late 2020s. And so again, I mean, you're investing in the sector with fundamentally different timelines. Okay. And so if you're buying the most advanced assets today, then by 27, 28, 29, I think that's when it's reasonable to expect them to begin coming through. Right. So what we wanted to do, and that was really the opportunity that we saw that was just incredible when we started the company. So you wanted to go and buy those assets when you could. Because I mean, again, they don't hang around for too long once people's attention is really focused on.
So how do you value these things yourself, actually? Because it gives a clue as to how we should value them. Like, because if they're going out the long term like this, you saw Sibanye Stillwater pulling out of a $1 billion transaction in South America recently. Things go wrong, right? So how do you look at these when you're valuing the royalties themselves and their likelihood of success or contribution towards, revenue as you predict? I mean, you must discount, I suspect.
Of course. Yeah, look, I mean, every deal, if you look at where we've bought, I think we bought about probably 0.3, 0.4 times net asset value, assuming 325 copper. So that's obviously a much more conservative metric than paying net asset value or a premium to net asset value, which you've seen a lot in other situations. So you absolutely want to give yourself a cushion on things of this nature. And again, I mean, where we think the really compelling opportunity is you're buying legitimate tier one assets that are really the future of the sector. So we really don't see the production risk as terribly high when you actually look at where these assets are situated. And if you can buy them at very reasonable valuations, like we've done, we feel like it gives investors and diversify the portfolio as well, because I think that's also a critical part of it. You're really giving yourself, the company, and then obviously the associated investors, just a great risk reward proposition throughout the years. Now, what we wanted to do as well is obviously fill in the near term, midterm cash flows of the company as well. So we bought Aranzazu in August as the first step to that. And we've got a lot more that we'd like to add through, because I mean, what you ultimately want to do is create sort of a nice, consistent ladder of cash flows throughout, right, from the near term to the midterm, and then obviously the big projects will kick in the late 20s. But long before that, I think now that we have the base of the company set up, you can add cash flow to it at much better terms and much more organically than you could in the beginning. When we did the Aranzazu, it cost us about 3% of our shares outstanding to basically get the royalty that we liked a lot and also filled the majority of our G&A needs. Okay, so let's look at that. Just again, I'm just trying to understand how you're building this, how you're smoothing those curves, as it were. So if you look at, you talked about obviously a longer cash growth profile in there. What does that look like to you? You're talking obviously back ending 2020s, but you might be able to smooth some of those curves with some different types of acquisitions. Not necessarily just in terms of near term producers, but the types of developers, different scale. They're not the tier one guys. There are lots of smaller copper companies, that perhaps could fit that profile and do that job for you. So how are you looking at that, smoothing that cash growth profile? Absolutely. No, listen, I mean, I think I think when you build this out, especially from scratch, you kind of have to define your stage as well, so that you do what can be done today. And then once you have a better base, you can do something else tomorrow. So the opportunity we saw in the beginning, which we saw as an absolute must-have, is you have these tier one royalties available. It hasn't yet garnered full attention of everyone else. Buy as many quality ones as you can that you think will really be a part of this cycle. And I think that's in and of itself is a super compelling opportunity. At the same time, you're building a company. So once you've done that and you've built a solid base of value, you want to go and look for smaller deposits that are also high quality that can give you some near-term, mid-term cash flow. So Aranzazu is step one of that. There's other high-quality mid-sized copper mines out there, some public, some private, where that can work. And we're very focused on those types of opportunities for sure. But those are different conversations, aren't they? Because they may not have
a royalty on them at the moment. So you'd need to talk about potentially origination, or maybe they do, in which case, those are going to have a different cost profile for you. They're going to cost a little bit more, right? So how many more of those sorts of nearer term revenue projects do you think you're going to be able to land in the next, say, couple of years? Because obviously the end of 2020, end of the 2020s is a long ways away, right?
Well, forecasting deals is tough business. We've done 8 and 15 months, but I've never forecasted anything that we could possibly do, because things change very quickly. But look, we see it. So
you got one
there in front of us.
You telling me you've got one, and that's in the bag, is it?
It's done, and so it's generating cash and the like, and so. But it took us 18 months of watching it, evaluating it, and negotiating it to get it done. So the good things take time. What we do, Matt, is just we cover the whole sector, every copper mine in every place that's of interest to us. We track all the time. But it has an existing royalty or doesn't have an existing royalty. That's a separate conversation altogether. And I think in terms of what we see in front of us, in terms of where the assets are, what the sector is, we expect ourselves to transact on more opportunities in the coming years to balance out the near-term, mid-term cash flow profile in a real way.
Right.
And then just like when we built the company, when we went public, of our assets right now, the top 4 or 5 weren't even in the company at the time they go public. I could never forecast anything like that, but we had confidence in our plan, and we've just been executing. So we're pretty excited about what's coming ahead here.
Okay, so just help me a second to try and work out some numbers of how many more of these projects. So with that one project, right? So
yes.
That is based on what, reserves only, or resource, or or do you cash flow forecast include exploration targets? I mean,
no.
What's the profile look like?
We never put exploration targets. The only thing we used in our initial cash flow forecast was reserves and M&I and merged and indicated resources.
Okay. So
that's the only thing
so paint a picture of that profile, the economic contribution, the time frame, etc. So I'd like to say, okay, if you did 2 more of those, you're kind of good. That would make sense. So what you got to get after.
I think that's very reasonable to expect at least 2 of those in the coming couple of years, for sure.
Okay, right. So right. The other thing you said in there, which kind of interests me, is the way that you go about looking at it. Precious metal companies, when they're small and they're just starting off, they're scrabbling around looking after the small stuff, and then they kind of work their way up the food chain. You've gone to the other end of the table and said, we want the tier 1 stuff first, and then we'll kind of backfill everything up with these developers, etc. So that's different. Okay, that's different. And I think precious metal companies, quite a few struggled at the end of last year. Maybe there's 2 or 3 he didn't, as precious metals. Prices stayed up, but the equities came off. So I think it's sort of, it's kind of interesting to me, the difference between you and them. You pointed that out a couple of times. But coming back to your portfolio side, one of the other differences is you don't have a lot of royalties. It's a smaller portfolio size. So why is that?
You don't need a lot of royalties.
We do. Precious metal companies, they want loads of royalties because they all get the same multiple, the good ones and the bad ones. So that's their game. So why don't you?
Because the thing is, when you look at the royalty space, all of the return, all the outperformance has actually been generated by a very small number of assets. So when we started the company, we didn't want to be a small company. We saw an opportunity to build a major company, and you have to do that from the start. So buy the major assets. That's probably a good way to start. And so I think when I look at what we have, these are some of the most important assets being advanced by serious companies, whether it's First Quantum Taka Taka, whether it's Copper World by Hudbay, whether it's Overunion by Teck, whether it's Visca Cheetahs. So with Dumont, it can keep going down the list. And so the reason we did that is because we knew that if we bought the tier 1s that are actually moving, the company would have a permanent space in the sector irrespective. And so obviously you want to have near-term cash flow, but it's much easier to backfill near-term cash flow when you have a base which is just irreplaceable. And so, I think, and that's actually been some of the best feedback we've gotten from people in the industry, is said, with the assets that you have, you're really just a fixture of the sector. And that's what you want to get yourself to. And there's some great opportunities there we see in front of us, and I think will come as well. I mean, I think the royalty model will become that much more widespread as the sector evolves. You're seeing much more inflation right now. I think equity valuations are definitely struggling because even though you have higher commodity prices, a lot of that is getting eaten up by the cost inflation as well. So I think that the royalty model is really a very sensible way to fund the sector in general. Obviously, it has its limitations like anything else, but what we felt was we want to build a company that really will have a seat at the table for a very long time. And we're really happy with that first stage of that, but there's a lot more to do.
Yeah, there is. And the other thing I think there's a lot more to do is you guys kind of laying out the portfolio a bit more clearly for us. And been through the PowerPoint there, because I'd be interested in understanding not just the overall size, but in terms of, how many of them are sort of materially being advanced and at what stage? How many are 43101 compliant or JORC compliant, depending on where they are in the world, and being able to sort of understand the kind of the royalty linked reserves and resources more easily, so that can help us with sort of calculations. And it's difficult also for investors because if they're used to looking at silver or gold prices or gold equivalents, like obviously for the copper stuff, you might be able to put out gold equivalent prices, numbers, I should say. Nickel a little bit harder because again, not many people invest in that space. How can you make it easier for us to actually value or calculate what it is that you got and where the value sits today versus as it starts coming in further down this decade?
Yeah, I think I'm happy to obviously go through asset by asset, but I think one thing I'll just say is I think if you see the business model is really systematically acquiring at the right price the most important assets in the sector, I think that there's probably a lot more value to that than just any individual royalty. And I think that's sort of when I go back to the investors that we've spoken with from the 25 cent round, I think the question was, well, what do you have? What do you have? What do you have? And they said, well, that's what we have today, but we're constantly adding to the portfolio, and it's meant to be a systematic diversification of critical assets in a critical sector. That's what we're really trying to do. We buy them at responsible prices. We've gotten 10% plus IRRs locked in based on public information, going out decades at conservative prices. So all those things, make sense individually, but even more importantly is what makes sense in the aggregate, because again, if you want to find a way to get exposure to these critical assets in this critical sector in this commodity, we really think this is the best way to do it, period. And we're constantly adding to the portfolio, obviously, but we're being disciplined about it. I think we get asked the question of auctions all the time and how do you sort of stay disciplined and you don't get into these competitive situations. Honestly, I don't think there's an easy canned answer to it, but this is the only thing we do. And so whenever there is something that's valuable to us and that's remotely actionable, we find a way to get it done. And I think that's really where the value of the company is. And I think that's what people can expect us to keep on doing going forward. But yeah, look, of course, happy to go through the assets one by one to give more context in terms of what's going on.
Right. Okay. Well, or just lay them out better for people to actually, because I think the problem with royalty companies is I like royalties. People like the idea of royalties. But when you can present a lot of data, even brokers can't be bothered going through it. They kind of rely on you to tell them what is there, and investors even more so because they're not used to sort of doing that level of analysis on a project. So either they're going to say too much to understand, I'm off, or go, yeah, whatever you say is true, and that's not good either, right? So for instance, like on your portfolio, trying to understand what the kind of organic potential is, or what your future M&A targets are. Those things are kind of useful series of questions to kind of run through.
Of course.
So, do you something you guys must track? I don't want to go through organic growth, one project at a time. That would be painful. But
I think that's actually a great idea. Okay. When we buy these royalties, let's go through the math on Taka Taka, for example, which is our most valuable royalty. I think at this point, it's fair to say we own a 0.42% NSR on a mine that First Quantum is estimating will produce somewhere between 200 and 250,000 tons of copper a year. So copper attributable to Nova is somewhere between 800 to 1,000 tons a year. That's something that's attributable to us in terms of on an annual basis. You take today's prices, that's roughly $8 to $10 million a year, based on today's prices. And again, by the time it gets built, which will be, I think they're forecasting that construction would start probably sometime in 24, maybe 25, depending on when the formal decision is made. And then say up and going by the late 2020s. What kind of copper price do you need to build these things when you look at the permitting delays everywhere? Salta, where Taca Taca sits, is as friendly to mining as any jurisdiction in the world. And these mines, when you look at the history of them, they get built at one size, but then they keep on expanding. Usually a big copper mine has multiple stages. And so this 200 to 250,000 tons a year, that's stage one. But this is a mine just in terms of context and size. It's, people have talked about it potentially if it can grow to be the size of Escondida. I think that's pretty aggressive. I mean, obviously just saying, but the fact that someone even brought up those words, it gives you the scale of the deposit. So, I mean, so if you look at the geography, Taca Taca sits 90 kilometers east of Escondida on the Argentinian side of the border. And so Escondida, I think, is 6 billion tons. Taca Taca is 3 billion tons and still growing. And really, it's going to be a district, just the way the First Quantum is approaching. They're forecasting initial capex of 3.6 billion. So what we see is an initial mine plan of 250,000 tons a year, say 800 tons to 1,000 tons attributable to Nova. As the mine expands, I think copper prices, just given how hard it is to bring on supply, have some room left. But we never forecast that. We still run it at 325. Even though it sits at like 440, 450 right now. Mm-hmm. So when we look at the base case, and we paid in total between the two royalties, we paid $33 million, which includes $4 million of the at production for the royalty. That, say we'll do $8 to $10 million a year. The initial mine plan is 32 years. When you look at the average copper mine in the world right now, in the top 60, the average expected life is 77 years. And they all started out at a much lower level, and obviously just kept ramping up. So when you look at the fundamentals of that investment, and we were fortunate enough to make the first stage investment before First Quantum announced those plans, it's really just one of the best risk-adjusted bets you can make. So we're very happy to let that asset mature, have them build it, hopefully see them expand it in a very supportive jurisdiction. And that's something that we see as just an exceptional source of value.
Okay, and that 0.42 is over the entire asset. If they expand it, you still get your 0.42.
Yeah, so basically, if you look at the royalty area, it covers basically the entire mine plan. There's a small piece which is left out, just through the geometry of the deposit, but it's not terribly material.
Okay,
and it's effectively
okay. So that's a good example. And there will be things which work out in the portfolio, and there'll be things that won't, or they may take longer, and part of that's going to come down to jurisdictional risk. I'm sure you get asked this all the time.
Of course.
Which is you must have some concerns over what you're starting to see out there. Even First Quantum has been affected by things like this, where you're getting pushback from not just First Nations or indigenous populations, NGOs. You've got locals concerned about mining processes, and there's a big cry for innovation and change, and for mining to basically up its game. But those are causing delays, and time is money. So again, when you look at your portfolio, will you be advising your shareholders and the market of your concerns about specific assets? Because again, something we see in precious metals is those things kind of people forget to mention them.
Oh, listen, I mean, you're preaching to the choir. For us, jurisdictional risk is the first thing we'll look at. And I think, you've got to be, I think, very honest with yourself about what's reasonable when. And so when you look at Matt, what we spent on the portfolio, I think in total, we spent 65 million US. And so I think market cap right now is just over 200. And so I think what you try to do is be responsible with the capital and invest into things that make sense and where it can advance. And you're getting very good value for your money. I think it's critical. You definitely see some differentiation between places. Like I personally am very bullish on Salta and San Juan in Argentina. I think that, what I see over there, I spent over a week there in December. They're very supportive of mining, very bullish. You probably much easier to permit there right now than most places around the world. Obviously some things I've seen in the US, what has happened in Chile, there's definitely pause for concern on specific situations. But where we feel like we have exposure, for instance, we have royalties on both Visca, Cheetahs and West Wall in Chile. And so those two are the largest, most advanced greenfield projects in Chile's second largest copper belt, which is 25% of the country's production. And they're 15, 20 kilometers apart. We see this as the next major camp in Chile at some point. West Wall is owned by Glencore Anglo. Visca Cheetahs is, I think at this point, considered probably easily one of the most advanced copper projects that are not yet owned by a major. So timing can get impacted, but when you look at our cost basis on those deals, we bought ourselves a lot of time, which I think you have to do. Because when the opportunity is there to get something good that you think will get developed in time, there's obviously some near-term risks you want to manage as much as you can. And then that has to be done also as a function of price to make sure that you don't overextend on something where you can get really impacted by a big delay when you've paid for near-term production, for sure.
So since we spoke 2 years ago, two years ago in October 2020, you're double the share price. Well, just under double the share price from when we spoke. So you'd have taken that at the time. But the truth is, you kind of shot out of the gate. You come off a bit, and it's going to move sideways most of the year. And is that what do you do about that? Because it's like, if we get more of that in 2022, or maybe people are thinking, I need to wait till the end of the 2020s to actually, benefit from from investing in this thing, or I'm going to park my money for a long time. How do you keep the growth component of the investment going? Because share price moving sideways, retail probably need something to kind of get them going. It's too small kind of for the big, institutional guys. I know you're on the TSX now, which is great. But you're going to need either some big acquisitions, of which we discussed today. There aren't that many projects out there, right? You know where they are. It's a question of, can you get a hold of them? Will people sell the royalty, or can you create royalties, right? So how do you get the excitement going again, or at least a steady increase?
I think the first thing we try to do when we buy things is you obviously want to buy things that you see advancing in some reasonable future. So when I look across the portfolio, each one of our major projects, from Taka to Visca Cheetahs to Aranzazu to Dumont, they all have material catalysts, and Copper will have material catalysts coming up this year. We're getting that much closer to availability and production, which I think is critical. And I think as investors, again, what you're seeing also is just lack of supply that's becoming more and more apparent. So I think that investors, as the portfolio matures, and look, obviously there's more acquisitions on the horizon, but I don't think you want to be just an acquisition machine that always needs to buy more to keep people's attention. I think the key what you're trying to do is really buy durable pieces of the infrastructure that, as they advance and become more viable, people realize that it's a really exceptional portfolio.
But explain that, because I think most people's experience is the precious metal market, because there's more precious metal royalty companies than anything else, right? So that's what they see. People, the M&A machine seems to work. We've had new entrant into the place. Gold Royalties, right? They don't have a lot of revenue. They're trying to buy up companies with revenue to kind of help them on that front, and obviously benefit from the increased multiple on the new portfolio, right? So they've got a very clear model, 600+ million market cap, right? They're a promotional machine. It's fantastic, but there's there are other companies out there who are perhaps struggling on the promotional side of things and trying to do things the right way, but they're sitting there at sub 100 million market cap because no one's interested in this story. They don't necessarily buy what you just said about trying to buy cheap, trying to buy well, looking at this kind of sustainable cash flows on quality projects. So if you were to excite the investor market, do you need to do something different, or do you think eventually people will understand what it is that you're trying to do?
Listen, I think we've got a pretty supportive shareholder base. I think the only reason we're probably talking about it is because we shot to $6 so quickly. It's one of those things where sometimes the markets get excited and it's too much too soon. But look, we came out at $1. Right now we're around $3. I think the market's been really supportive of the acquisitions. I think people see the scale of the assets. The assets need to advance further, but they're advancing. Again, these are permanent pieces of the infrastructure. The company has the scale in terms of assets, I think, to get people focused and excited for a long time. What you want to do, I think, from our perspective is, it's not like you're done It's not like you're done building. We really saw this company as having a chance to become, really having the lowest cost of capital in the entire commodity sector that we are in. Just like on the precious side, you've seen some of the great royalty companies, because they're diversified, because they're cash flowing from a number of quality assets, because they don't have the same cost and capital pressures that the producers do, really become the investor's preferred choice in investing in those commodities. That's what we see for ourselves as the future. And you build that one at a time. So we've been pretty aggressive on the acquisition front. We've done, 15 months or whatever it's been. We see some things we're excited about, but again, it's just methodically building the value pieces. First part was the big ones, then you go to the mid-tier ones and you balance it out.
Do you feel you've got that right? Are you sure that you got that right? Because the order of play there seems to have confused people, and they're looking at not a lot of revenue early on. So you think people understood that?
Oh, absolutely. People absolutely understood that. I mean, the thing is, I think that's probably why you saw so much excitement earlier, is because you had a new company buying Taka and Overunion and things that are usually reserved for the big royalty companies. I mean, I think it's when you can get the scarce pieces, you grab them. And you don't ask yourself questions of whether they need revenue. Revenue you can always get, like we did later. But even when you get the revenue, you want to buy that from quality assets. I mean, I think, value in royalties is driven by quality assets that keep on expanding. Whether they're big or whether they're smaller, that's really, I think, the main focus of what you're trying to do and generate a return for your investors. So I think that's always the focus. I mean, absolutely. I mean, if you look at capital deployed, we've deployed, 65? I think market's saying that that's worth just over 200. So I think they're pretty happy with how we spend the money. And whenever we find things we actually want to spend money on, we expect we'll get supported again.
So what would you say? What would you say to that audience? Because you need a bit of retail to kind of get the liquidity moving. Okay, the average trading numbers are not that much, and you don't know how many people are sitting holding on, hoping they'll get back to the $3, which the $5 that they paid at the beginning of the year. So what do you say to those guys in terms of that growth profile? And what type of investor they probably need to be. Clearly, it's a get rich slow scheme, but you're getting rich, right? But there's probably some trapped investors in there. How do you swap them out, and how do you get get that price moving again? Or is that not really an aim?
I mean, this is not the kind of stuff I think about. I mean, the thing is, look, your job is to create a great company. This is what you focus on. Somebody bought in at one level, what they want to do with their portfolio, honestly, is just not something that we consider on a daily basis. I mean, you're seeing a value build that is pretty fundamental and clear. You're seeing real diversification within a rare asset class, fundamentally. And it's one of those things that just keeps on building consistently year on year with real performance. And I mean, one of the best things for me to look at is how we evaluate ourselves is where you deploy the real capital. Have you seen advancement? And, from Taka to Visca Cheetahs to Dumont to Aranzazu to Copper World Rosemont, you see real advancement in the hands of real counterparties. And so markets, in the short term, I agree with you. They do all kinds of things, but I do think they do realize kind of real things over a longer period of time. And I think enough people have realized it. And I think more people will realize it. And so as the scale of the company grows, as the assets advance, as we add some more quality things as well, because we do have some great opportunities in front of us, I think the cumulative effect will just sort of automatically register. And then, and we have some great, one of the best things that I see in the company is, it's a very closely held shareholder base. It's really been there from the very beginning, supporting the company. So whether that's institutions like BD, whether that's royalty owners that vended in, that want to be here for the long term. And so that's, if I think about an audience, it's really the people close to the company that believe in the vision in terms of what we're trying to do. We have some pretty good support, obviously, from the market itself. And you just do one at a time and stay focused on what actually matters.
What's the percentage of institution?
I think right now, institutional between BD and the others, we're probably sitting around 15 to 20%, something like that.
Okay. 20%. Are you looking to increase that?
Of course. Yeah. Look, I think as the company grows, you obviously want to attract new people into the story that are excited about the opportunity ahead. And it's been, it was interesting, when we announced the Copper World Rosemont deal. It's a pretty high profile asset, so people knew it. And I think there was kind of a very good amount of interest that came out of institutional corners based on that. And so I think as the assets advance and we do more things, I think that will come organically. I think like one of the things we think about is, capital markets and shareholders and things like that, you want things to organically come into the company at the right time. We've had great support from key shareholders in the beginning as we were building it. Now, as we're getting bigger, we look forward to welcoming others, but it's not something that you think about all the time either. I mean, that you shouldn't.
Well, maybe it is on the institutional side because you need a kind of sustained plan of attack for them in terms of regular communication to try and get them to understand.
They're not all made equal. You need institutions who understand what you're trying to do, and this is not a 1 or 2 year plan. This is a decade-long plan. So you need people who want to be on side for that. I think one of the worst things that can happen to your company is if you have a short-term oriented shareholder base. I think you just won't have the ability to execute on the plan you actually need to do.
So do you guys get taken out? I mean, I'm trying to think because you don't have any competition. I'm not sure who would take you out, but if they did, they might be coming after. Obviously, future revenues. It's not going to be near-term revenues. There's drivers. So, is that a possibility?
I mean, it's not a possibility we think about too much because we've got a business to build. To be honest, I've never thought about. I mean, you don't build a company for somebody to buy it, but you're a public company. So if people are interested, they can obviously always reach out. I mean, that's part of your job, but. We see a multi-generational business really fueled by the world's most important assets that we're trying to build, and we've made some good progress. So that's really the focus for us, Matt.